Welcome to the Signet podcast. Normally, I don't ask current event questions, but when I shot this video, we were going through a bank crisis. This was about March 2023. This is when Silicon Valley, Signature Bank, First Republic were going through their problems and the bank bailed them out. Listen to Mac's perspective on what happened with the banks, and if this ever happens again, pay attention to the ingredients that he talks about solving this crisis.
I think it could have been really bad. I think that they stepped in. The biggest concern was runs on banks.
Yeah.
Right. The government did what they had to do and step in and backstopped and basically insured 100% of all depositors' deposits. And it's funny too. I was talking to a buddy a couple days ago, and he said, "Did you even know that it's only insured up to $250? I just always thought my money was safe." And I was like, "Well, yeah, I did." But I guess a lot of people didn't realize that.
Right.
And when you have these companies, businesses that have millions, tens, hundreds of millions of dollars, and all they're going to get is $250,000, that's going to break the economy. And if businesses and consumers don't know that their money's safe, they're going to make a run on the bank. Had that happened, if they didn't step in and do what they did as quickly as they did, it would have been really, really bad.
Yeah.
Fortunately, they did. So it's yesterday was kind of crazy. This weekend was kind of crazy, but today it's kind of back to normal to a certain degree. Now the Fed has a decision they have to make. Raising the discount, raising the rates as the Fed's been doing so quickly is what caused a lot of these problems. Now you could also argue that there was investment management issues, and maybe they shouldn't have taken so much in long-term bonds at such low rates. But the bigger problem is also how fast the Fed has raised the rate. It's kind of unprecedented what they've been doing. They've been doing it to curb inflation. But now we're at a situation where today the inflation numbers came out, and core CPI was hotter than expected. So inflation's not cooling the way that the Fed wants, or really that even consumers want.
Yeah.
So they want to continue raising the rate, but now how are they going to do that and also keep financial stability in the financial markets? Because you have a lot of these banks that have long-term bond loans at lower rates. So the higher the Fed raises the rate, the lower the value of that asset is, and that's ultimately what happened with SVB and the other banks.
Right.
These banks aren't required to put their mark-to-market value of that asset on their balance sheet.
What do you mean by mark to market?
Well, so I bought, let's say this bank had, $2 billion that they bought, and I'm just making up numbers here. So don't take that for anything other than, but you buy $2 billion worth of bonds at 2%, and today bonds are selling for 6%.
Right.
Well, why would anybody buy a bond for me at 2% when they can go buy it for 6%? So now my 2% bonds are worth less than the $2 billion I paid for them. You have to do the math and figure out what are they worth if those bonds are at 6%.
So mark to mark is when you.
So the mark to market is the value of
it today.
Yeah.
Oh,
right.
okay, that makes sense.
And they don't have to put that loss on their balance sheet. So their balance sheet still reflected the $2 billion, again, made up number, that was on that they had invested in those bonds.
Yeah.
People got wind of it. It was interesting, actually. I heard somebody's theory is Kramer came out on February 8th and said SVB is a great buy and all this stuff. And a lot of people have been talking about that. But one person said, that actually drove people to figure out what was going on, because a lot of people started looking in and thinking, maybe I'll buy this. I don't know how true this is. I thought it was an interesting theory. And then, you've got guys like Peter Thiel who are very influential and started telling people on Wednesday, Thursday last week, hey, this doesn't look right. You need to start pulling your money. And that's essentially what caused the run.
Right.
People started pulling out their deposits very quickly.
Right.
The bank then had to go sell these bonds that aren't worth what they paid for them, because rates have come up so quickly to cover their capital reserve requirements. And the whole thing cascaded. So that's where we are.
Hey guys, thanks for watching my video. I really like making these. What would make my channel much stronger is if you leave a comment below. Tell me what you want to see. I want to know.